Good afternoon, everyone. In today's video, I'd like to cover two different topics. The first is doing a quick recap of the trade we set up yesterday in Zillow based off of our bullish short squeeze signal, along with the high short interest percentage. And then second, we'll take a look at all of the breaches. We'll cycle through this fairly quickly. We had a series of breaches, successful breaches towards the final hour of the market. So we'll cover all of those as well to try and gauge what we should do to prepare for triple witching Friday. All right, so starting off with the trade in Zillow here, we set this up yesterday where we had a bullish squeeze signal, we had a bullish market pulse line, we also had double-digit short interest percentage, all of which to me suggested that we should see a pretty nice move up in Zillow. Now today Zillow is up 4.18% to close. I think it was up a grand total of 5.58% from its low to high. So all in all, a fairly nice day of trading Zillow based off of the trade we set up yesterday. And we had two different trades that we had set up. The first was the 95 to 100 with 2 days to expiration. This was the one which yesterday I believe this was trading for something like 45 cents. Today worth 1.16. But the one that I think was more realistic, of course, not knowing that this move was coming, was a 95-100 call debit spread with 30 days left to go. This was 31 yesterday, which yesterday this was trading for 157. Today trading for anywhere between $1.90 all the way up to 225. And this also exceeded 225 when we saw that plus 5.5% move in Zillow. So for those of you still inside of this position, the next batch of targets, so we hit our first target today, that 1618 extension. The next target to me is that 100 zone, which I expect we're really going to hit that 100 into triple witching Friday, chop around sideways, have something funny happen there, maybe have a slight little pullback before you see the next move up towards the 200% extension. However, if we continue to see the squeeze just start to fire up bullishly, don't really see it pause at 100, then the next target is at 113.32. So that's how I would manage the trade for those of you that are still in it. Gave us a pretty nice winner already today. For those of you that got the 2 days to expiration option early on in the morning, that rewarded you really, really nicely just in one day, just a couple hours actually, which was a nice trade overall in Zillow. Now next, I'd like to switch gears and move on to our futures volatility box, where we had a bunch of trades set up in our major indice markets, and all of these came in that final hour of the market close. So if I load in our scalper volatility box models, and these are the updated scalper models as of this weekend, this is where we purposely made them a bit more conservative, trying to predict for the volatility that I think is to come this week. We also have triple witching on Friday, which I think is going to inject some more volatility. The entire week has really been a test of patience in terms of sitting there waiting for our breaches. However, we've also seen that anytime we do get a breach, for the most part, that breach has been incredibly successful in terms of a nice winner. That theme continued on today as well. So if we take a look at the S&P futures here, in the final hour of the market, we had a breach of our volatility box cyan line. And from that point, you saw we had pretty nice reversals, right? We had one reversal right here where you hit that first target, which is that bare minimum move, which to give you an idea of what that looks like from a point basis, that was right around 6 points. We ended up going a max of 9 points in this move. Then we had a retest of our cyan line. Then once again had a pretty nice reversal from that point up another 14 points before coming back down. Now, in both of these cases, we didn't see an edge signal, and I alluded to this, I believe, in Monday's video, which was the idea of using the cumulative tick to try and gauge a better way to use market internals to try and at least predict a place where in which you had a reversal, high probability reversal areas where you can participate in this instead of using the full size futures contracts with something like, say, either the SPY ETF, the SPY ETF options, or even the micro S&P futures, all of which are ways to try and reduce your risk. Now, in the case of the S&P futures, you take a look at the tick here. Let me zoom out first so we get a better idea of this. And one of our members asked about this as well, which I think this is just an interesting observation. I'm not sure there's a very easy answer here, but it was you saw the cumulative tick really starting to have an upward slope here, increasing, while you had price action decreasing, right? So that's a divergence in itself, a great spot from that member. And then you saw this theme really continue into that hour in which we had the breach. This is the final hour where you saw the markets fell pretty sharply, but the ticks in that same period, if you take a look, continued to increase, suggesting that the internals weren't really supporting the move that we saw in price action, which I thought was fairly interesting. And that's a way to try and gain more confidence to catch some of these breaches, especially when we don't get things like our edge signal from the place in which we get the breach. Now, of course, this is a much more aggressive trade, but you can also see how this aggressive trade using something like the micros, using something like the ETF options, gives you some pretty nice winners. If we switch over from the S&P to something like, say, the Nasdaq, you'll see something similar as well, right? The Nasdaq fell a little bit deeper into the clouds, but same exact thing. the tick didn't really have a sharp decline. You didn't even see it starting to approach the zero line. You really just saw it chopping around sideways, whereas price action in that same period, if you take a look to measure what this decline is, dropped what, close to 1.5, 1.66%. And so I thought that was fairly interesting as well. Very similar concept here. You breached our volatility box cyan lines. In this case, in the case of the Nasdaq futures, you had multiple edge signals. You had some pretty nice sharp reversals there, giving your bare minimum first target move, which is what you would be risking from the cyan line to the outer edge of the clouds. Before then, you saw price action fell right back down into the final close of the hour. Now switching over to the Dow, very similar concept as well. Didn't fall as hard, but the ticks in the Dow gave you an even clearer picture where for most of the day here, you really just chopped around sideways. Now, of course, the scaling on the Dow is a little bit skewed based off of our ranges that we coded as part of the Pro, but regardless, the same exact concept applies here where the ticks weren't supporting this move. Again, you fell into the cyan line, gave you almost a picture perfect reversal, right? We missed our levels where I think off by what, 11 points on the Dow. So you're 11 points away from pure perfection in terms of nailing the levels to catch the reversal into the final hour of the market. And then finally, take a look at the Russell here. You'll notice something similar as well. The Russell fell into our volatility box cyan lines. Again, the tick didn't fall anywhere close to zero. And from that point, you had a pretty sharp reversal. Now, if I bring in some other markets as well, in which we had breaches today, so natural gas, this was one which I called out in the morning note. Out of our three energies between crude, copper, and natural gas, you saw that natural gas was the one that had the most volatility. That was purely based off of this early morning move right here, where you had a pretty sharp decline in natural gas, where this was the only market in which we came even close to breaching our cyan line by 7:30. Now, of course, this was a whole lot of waiting game, but if you were patient, if you had that virtue, you were rewarded in that 12 to 1 p.m. Pacific hour, where again, you had price action fall into our cyan entry lines. You had the edge signal. You had price action chop, consolidate, and from that point had a pretty nice sharp reversal in natural gas. Now the trade in natural gas was even more beautiful in the sense of risk, where your risk there was only 6 natural gas ticks, which I think is a pretty phenomenal risk to reward ratio based off of the move that we actually got, which into the final what closed in the open so far, you see it's currently up a grand total of 21 for that initial risk of 6. So I think that's pretty interesting. Take a look at gold as well, which currently we have the scalper models testing on. You'll see both the scalper and the aggressive breached. In the case of gold, something very similar as well, right? We breached. This was towards the edge of the hour, but in the 11 to 12 p.m. Pacific hour, so 1 hour before the market closes. And even from that point, you had a pretty nice reversal. The risk in gold was a tad bit higher, right around 4.4 points, but you saw that 4.4 being immediately hit off of that reversal, went a grand total of 7 before coming back down and then again starting to make its move back up in gold. Now, the one market in which we went outside of our clouds was the 30-year bond, in which if I load in our aggressive volatility box models, you'll see that we went outside of the clouds, and that too in the hour before we had all of our breaches in the indices. Thought that was fairly interesting. We've been using, this is a consistent theme of the 30-year bonds as a precursor of the volatility to come in the indices. And today, similarly, we saw in the hour prior to when we had all of the breaches in the S&P, the Nasdaq, the Dow, and the Russell, we saw the 30-year bond really give us that little bit of a hint that, hey, you should expect more volatility starting to pick back up. And we had the 30-year bond break outside of our models. Now, once we break outside of the models here, we didn't see the edge signal in time, and you don't really have something like the tick to support the 30-year bond, but that's where you have other models to help you keep adapting. So if the doomsday didn't hold, coming to the conservative, you'll see the conservative models, again, helped you adapt to the volatility you were seeing in the 30-year bonds. And that, again, helps you set the stage, pave the way for any other breaches that you have the rest of the day in the 30-year bond. So today was a pretty nice day of trading. That trade we set up in Zillow yesterday ended up working. For those of you that took it, you were up a pretty nice amount early on in the morning, up I think a grand total of 5.58%, I think it was. And then for those that trade just the futures markets, you had a really nice breaches that gave you successful winners in the S&P, in the Dow, in the Nasdaq, in the Russell, in gold, in natural gas, and then you had the 30-year bond in which we fell outside of the volatility box clouds. All right, hope this video helps and this recap of all the trades helps to give you an idea of ways in which you can be a little bit more aggressive on some of these trades. Keep in mind, we do have Triple Witching Friday at the end of this week, this Friday. And so for all of our Volatility Box members, both our futures and stock members, we've made the models purposely more conservative. We've adapted some machine learning techniques here to try and at least get ahead of what I think is the volatility that we'll see into the rest of the week. Keep in mind that is going to require you to be a bit more patient. Compared to our typical scalper entries where we saw multiple entries during a day, we're not seeing that same level of volatility, but I think we're also getting rewarded for being incredibly picky around the trades that we do take. All right, hope this video helps. If you have any questions, feel free to email us. Otherwise, we'll see you in the next update. Take care, everyone.